Okay, folks, we're going to be doing a price action lesson on the index futures. As I mentioned, my focus this week would be on these markets, and we'll do another one on this coming weekend. Now, obviously, these types of things don't lend only to index futures, but they lend well to other markets as well. So, if you recall, we talked about, or I drew your attention to this volume imbalance in here. And I mentioned that that would be a factor for future price action. It drew price up into it here, and we had a little bit of a reaction there, and then price came right back up into it again. So you can see as it went back up into it again on this day here on May 11th. Okay, and that was a Monday. And I want you to think about how also it trades up into the actual highest candle here. Now, you guys are usually familiar with trading the last up close candle, which is the bearish order block. But the up close candle and its closing price. Okay, so that's 29.41. So price trades above that on this day here, the 11th of May. I want to go down into May 11th and look at a 4-hour chart inside of this fractal here. So all of this price action right here. All right, we're going to go into a 4-hour chart and look at that. All right, so here we have the 4-hour chart on the E-mini S&P futures. This is the June contract, and 4-hour, as I mentioned, we would drill down into. And price got really close to running this high here, but again, as I talk in the core content, the rejection block is one of the most powerful predictive levels to either reach for a target or anticipate as a false breakout type pattern. You don't require it to trade above the absolute previous high. So if we add some of the lipstick on this chart, I have 3 things added to the chart now. This level here is the daily rejection block, and this is our SIBI. Okay, so all of this imbalance in here, price goes up, rebalances it, and then trades above the daily rejection block. The very next candle, it trades at the open above it and then comes back down below it. On the 11th, this is your first candle of the 11th, and price trades back above it here, right in here. I'm trying to get this thing to show with this little identifier still popping up, but it trades above it and then comes back down. Okay, so right in here, that's a trade. But looking at what is over here, if this is in fact a rejection block and you don't actually get the short at the rejection block, that's fine. You can use the return inside of the SIBI, sell side imbalance, buy side inefficiency. You can trade at the consequent encroachment of that as well. So once this happens in price action, you can go right in here and start looking at the levels where price should gravitate towards. And I'm just going to put a few of them on. Don't want to make it exhaustive because I want to leave some of it for you. Alright, there's 2 of them, and then we have the old low here. Alright, now there's more in here obviously because you guys have gone through core content and you can pick up specific discount arrays to aim for, but this is sufficient enough. Now, moving forward, 1 candle, you can see we dropped down. We had a break in market structure here. So now if we can go back up into this SIBI, either to the low of it or consequent encroachment, that would be an ideal scenario to look for a potential short. And we could sell short with that if we have supporting evidence. In other words, do we have something in the marketplace that would indicate underlying selling by smart money? Okay, so now we're going to bring in SMT ideas and look at the other indices to kind of really build a strong narrative that this market should drop lower and should trade to these levels respectively. Now, right away, if we look at the low to this low and you project it out, even if we drop down at whatever that trend line would be, obviously that would be another false narrative where retail would look at that as and say, well, it should be a buy signal because it touched diagonal support. And we're not relying on that. We're relying on the underlying pinnings of the market where it rejected. It's shown a willingness to reject. So therefore, what are we looking for in terms of downside objectives? Well, you have to look at the range that we're working within. So the dealing range from here to here. So this is the most prominent or parent price swing. And then we have subordinate price swings. We have this low to that high, this low to that high, this low to that high, and even this short-term low here. But if it's in such a close proximity, I wouldn't even consider this. Let me just go back to the old low in the price swing. Now, going one more candle forward, right there, price trades one more time into consequent encroachment, and we don't really require it to trade all the way up and rebalance to the high end or the premium level of the CIVI. So getting short at around 29.32, 29.33 in that area, that would be a pretty nice level to look for a short with this reasoning. And again, the reasoning is the market ran up to a rejection block and we wait for it to show a willingness to want to go lower. It does. We have a break in market structure. That's what we have here. And this rally here, this is kind of like a Judas swing. It's a real quick, sudden, we made a mistake type thing going this far, and traders are basically piling into it, buying it with the assumptions that this is going to be a continuation, is going to go higher. The underlying narrative is it's weak because it's gone up into an area where it was a weak delivery of liquidity. The volume imbalance on the daily chart, we had it here and we're back into it here. So if it is weak, it will show a willingness to be weak, and it does here. This is your signature. You break in market structure, runs back up. Now don't think that this is, again, just, well, this is SPOOs. Okay, I'm not trying to trade SPOOs, Michael. Take the name tag off. It doesn't matter. This could be wheat, or it could be lean hogs, or it could be copper, or it could be sugar, or it could be a stock, or it could be a cryptocurrency. Okay, so don't think that it only works with the index futures. It's how the markets book. It's not a matter of, well, it only works with this market here and not so much on that one. None of the things I teach, unless I specifically tell you this is directly linked to these specific signatures with this particular market, and there are specifics where it comes to the bond market. There are specifics when it comes to futures and index futures, but I'm not covering that here. Okay, all I'm looking at is pure price action and then reading the tape, teaching you how these setups form, and it gives you a little bit broader idea versus what tomorrow's trading is going to be only. Okay, kind of like what the YouTube channel series I'm putting out, which is the Optimal Trade Entry Pattern Recognition series, which is just simply little snapshots of a specific time of day using a very simple rule-based idea, and that model is a real dandy. We're not talking about something myopic like that. We're talking about a little bit longer term. How to see these longer term price swings that are either short term in nature or one shot kill. All right, so the market trades back up into the CIVI and consequent encroachment. Just for the sake of completeness, we're going to get a rough idea of where that price would be for consequent encroachment. And again, it takes us around that 29.30 level. So we'll go with 29.30. Okay, so 29.30, that could be a short, and you have to use a stop above the last candle that trades above the rejection block, which is this candle here. So that candle's high comes in at 42. So 29.42, you'd have to have a 12 pip stop. Now, some of you will be like, ooh, that's a little too much, Michael. That's $600 per contract. I don't know if I can handle that. Well, you're not always going to be in a position where you're at right now. And $600 on a larger account may not be all that much in terms of percentage, but I got it. We're going to reduce it down and show you an example of scaling this with a top-down approach and also using smart money concepts to build in that sell-side narrative. Okay, so the next candle, You can see one more time, trades just about the same height of that one, and then we start seeing the distribution. We have one more candle in here. This candle alone, basically retracing back up, it could come all the way back up to this low here and rebalance immediately, or just simply as it's trading up, you can take that as a short and then anticipate it breaking lower. Now, what I like to do when I'm looking at price action is when I have a setup where we have a market structure break there and we have a retracement ahead of it going back below that low, I want to see this low here, or on any market, when I'm anticipating a break in market structure, or in other words, a trend change, if you will. I want to see the run below this to be very speedy, dynamic, quick, not like trying to just creep below. I want to see it have a really nice, easy run below that, because what that does, it indicates, it kind of like tips the hand of the market to anyone that's paying attention that this is absolutely now going the other direction. And anything going short until we get down to, say, this level here, or maybe even over here, that you still could take a pretty reasonable short and not expect a whole lot of upside retracements. It's going to be a very heavy market. And when I say heavy, it means it's more likely to continuously drop, and any retracements higher will just be short-lived and rather moot, and just aggressive selling should come in. So the next candle here, we have a retracement and completely up to the rebalance there. But I would still hold on to the idea that if we start breaking down lower, I really want to see this low be broken with momentum. Again, speed, distance, magnitude. I want to see it really show a strong hand with a candle that goes below this low, not just tipping its toe in the water, and it's got to plunge below that. Now, I'm not saying it has to come all the way down here in one candle, but it has to do so in a much more decisive fashion, whereas if it just does like this low here, when it broke market structure there, see how it has that tail and it comes back up. We don't want to see that here because it's already done the work. Market structure is broken here, so we want to see this low. Once it's broken, it needs to really start to move away, and that will really solidify the idea that we're framing for this lesson. Next candle trades up to the bottom of the SIBI. Now, if it gets in here and trades back to it again, you always have to be mindful that it may want to come back up and touch consequent encroachment or the top end of the SIBI. Because remember, this candle here is the last up close candle. But is that the order block? No. It's this one. This one's your bearish order block, not this one. So when we have this next candle, it trades up to the bottom of the SIBI. Whenever you have that, it can always go back to consequent encroachment or to the top of the SIBI again. So always be mindful of that. Even if it does that, this high should be held. And if it breaks, then you're wrong, and this isn't going to hold either. And what do you do in that situation? You take the loss. How's that for logic? It's simply going to be times where you're wrong and it's going to move against you and there's nothing you can do. But the next candle, we trade all the way back up to the top of that SIBI. Now, once it does this, look what's happened here. We have the imbalance that creates the SIBI. Market offers buy side, sell side, and then leaves it. And now it comes in one more time. But look at the distinction here. There's absolutely no body in that. It's just wick. It's all it is, just a wick. So it's going up in there one more time to take out these relative equal highs. You see that? When we drop down to our hourly chart, it'll be much more meaningful to you, and you'll see all these things I'm talking about here. But looking at it from a 4 hours perspective, right here, if you're not getting short in this touch of the top of the SIBI, or consequent encroachment, or the very next candle, right when it opens, so all you got to do, as soon as it starts trading, get in there, and your stop could be above this candle's high. So if you look at how the candle trades next, we open a little bit of a Judas swing here, and then we close down. Right here, I want to see price make an aggressive run below this low here. Now, it may take 2 or 3 candles, but once it gets below that low, remember, I want to see it showing really meaningful displacement, not just like this low here, and we went below it just a little bit and then started to go the other way. It's got to go below here and really run. Next candle, bingo. This right here is a huge move. Now, right away, anyone that's familiar with the S&P knows that this is a big sell-off. It's a lot of handles in there. That to me is not reasonable. It's not that what I wouldn't expect that much, but certainly going above this low here, like closing on this particular candle right about there, that would have been what I would have expected. But this is a complete washout. Now we have the BISI in here. So does price come back up into that and need to rebalance? Next candle trades a little bit lower, but look what it does. It leaves this low. If we start to retrace, we have to start considering this area over here. And we get it there. We trade up into it again here. This is a nice area we can look for a short to look for projected lows below this low, because now we have what? Relative equal lows here. So there's going to be a pool of liquidity. What kind of liquidity? Sell side liquidity. And then we have the sell side liquidity below this old low here. So what does the market do rather? It trades up, spikes a little bit above the buy side imbalance, sell side inefficiency, and that's fine. Remember, the wicks is what we're not really particularly interested in. We want to see the bodies. The bodies give us the narrative, and you can see the bodies are respecting that BISI. This could be another sell-off here. We'd see, again, the market tanks, makes an aggressive run below the relative equal lows, and then we have a retracement back up into, which everyone else knows in retail world is support broken, now turn resistance. What we're considering is this candle's low here and where we opened. So we're about halfway there now. This would be enough for me to look for another short. Next candle, we trade up just a little bit in here, halfway point, and then now look for a distribution on the downside again. Took a couple candles, again, retrace back to it again, bottom of the BISI. Then a big washout candle again, taking out the low. And I'll scrub over here so you can see all of it basically. All of this movement here to here, that's your weekly range. That's your one shot, one kill. That's your short-term trading. That's your swing trading. Okay? And it's using the market maker buy model that turns into a market maker sell model. Consolidation, leave it, smart money reversal, reaccumulation. They don't have to go above the old consolidation. This is where it stops. And then we create what? A market maker sell model. And everything that was used in this description here was framed based on those things that I taught you in core content. Now, let's go into an hourly chart and kind of look at all this price action too, with a little bit better detail. All right, so here's their hourly chart. And again, this is the June contract for E-mini S&P. And you can see here's Monday's trading, Tuesday's trading, Wednesday's trading, Thursday, and then Friday's trading and Friday's close. We're looking at the rejection block seen here on Monday. We trade above it here. Then it completes the return back to the top of the SIBI, which is framed by these two blue lines in here. And once we get down, like we move away from that SIBI's top end or premium end of its range, we have one more time. We run back up into the last up close candle with the biggest beefy body. That's your return to bearish order block. Price breaks down, and here's that low. Remember that 4-hour low? I said if we go below that, we need to see it be more pronounced, not just weakly going below it, but it really does so in stunning fashion here. Where our 4-hour levels I've outlined in here. Okay, just 3 of them. And there's obviously much more of them if you break it down into the 1-hour chart too, but just using the 4-hour chart makes it obvious and just easy to see. Market breaks the low that creates the market structure break, which remember this is that low initially. It breaks it here, it retraces, and one more time it blows out those equal highs as I mentioned on the 4-hour chart. There it is. Look at it going right to that level. Now again, this blue line is 29.39. The high on this candle here in the hourly chart comes in at 29.39 1/4. So when you see this, they automatically think, well, it's got to return back to that. So we have to look at this area here. Actually, let's use a rectangle. This area here it's one of those liquidity voids. No, it's not. It's not a liquidity void. It is a displacement. Okay, so this displacement in here does not need to come back up here and rebalance that. Now think about why. Why is that true? Because I get a lot of questions about what makes these supposed liquidity voids, because again, a lot of folks are familiar now because I put them on to Chris Lowry, and then I'm the only one that knows about the guy. There's people that's trained under him and trained with him, and they assume that that's his invention. That's something that he created or whatever, and it's always been in the marketplace. This is not a imbalance that has to be rebalanced before trading down to here, okay, below this low. You don't want to see this rebalanced if there is a shift in market structure back here. You want to see this displacement, and it should stay open. If it stays open, what is it really acting as? Is it a liquidity void? No, it's displacement. What is it displacing? Price on the downside, indicating what? That this whole business here is actually a breakaway gap. A breakaway gap, you want to see those remain open. That's why when you look at some charts, and you're going to find this a lot on different various time frames, but usually when you see a real fast market movement, higher or lower, and you'll see these candles that just stay imbalanced the entire time. They stay imbalanced because they're operating on the context that it's a breakaway gap. The market does not need to come back up to this point and rebalance. It doesn't even need to come back up to here because it's already done the required narrative. Breaking market structure from this low, here. Retrace, go to a premium. Go to a premium again, run stops. Break. Breakaway gap. You don't need this to rebalance, okay? You don't need that. You do go back over to the buy side of the curve in the sell side model and match that up so you can put your areas of going to go short. You would sell short based on that. And if that went over your head, trust me, in core content, we talk about the buy side and sell side of each model, the market maker buy model, market maker sell model, and how they are directly linked to the opposite side of the curve. And the curve is always from the point of smart money reversal. To the left, it's on a sell model, it's the buy side of the curve, and to the right of it's the sell side of the curve. And if you look at how the market creates, again, now look at this. We have one big sharp candle moving lower here. This is the same thing here in a trader that's just been introduced to quote-unquote imbalances. Okay, so they'll think right away this has to rebalance, and that's not true. That's how you know they don't know what they're talking about, or they watched a few of my videos, or they're just used to watching whatever Chris Lowry's put out. And again, I'm not trying to kick dirt in Chris Lowry's face. Like I said, he's the only person out there that I have respect for, but I'm not teaching his stuff, and I certainly didn't reinvent anything. So the distinction between this being a breakaway gap and this being an imbalance that would be reasonable to see it rebalance is the fact that the narrative behind this, we're leaving a market structure break. Here, we're not. This is simply just a retracement and an overzealous move going lower. The next candle we open, we rebalance, get a little crazy, and trade right back up into the last up close candle. It's a bearish order block. So we overshoot the SIBI and into a bearish order block. Then it starts to decline again. Now, in here, same thing happens here. We're not leaving a market structure break here. We're looking at an overzealous move that's going down. So we can use, again, the same protocols that we use for our imbalances. If we're short or we're looking to go short, then also remember, we're really close to our objective. So any retracements here are going to be really short-lived. They're not going to be a long-winded thing like this. It's going to be really short. What's it going to do? It's going to go above the last candle high that makes the low end of our SIBI. So what is this? All this is doing is giving us an institutional order flow entry drill. Go short there. Again, not demanding the full rebalance. We don't need that. And go to the left. What's going on? We have a mitigation block in here. The market is trading up into mitigating all of this right in here. So anything that was long, they clean that up. then we consolidate, and then break down to the old low here. Tuesday, short. Wednesday, short. Thursday, low of the week. Come off the low, consolidate into Friday's close. Power 3. We open here. Trade down, off the low, close here. Heavy distribution, everything on the sell side, based on the volume imbalance on the daily chart, coupling it with the weekly profile. We're looking for what? The market to trade up into that daily volume imbalance. Then it should indicate that it wants to go lower. What is the indication? A break in market structure here. And then once it breaks that low again, okay, once it breaks this, it needs to tip its hand to you. How do you know when market structures break and it's bearish? Can you trust it? It's this very lesson right here I just gave you tonight. And it doesn't just work on futures, it works on all asset classes. So now I want to go and look at something a little bit more detailed, okay, and we're going to add the other index futures, and this is the Dow, okay, and we're going to add also the NASDAQ, okay, and we'll close this up. All right, so now what we have here, in this area when we go back to the top of that SIBI, okay, when we went back up to here, this high is slightly higher than this high. We were running the relative equal highs here with this run. But look closely, okay, look really, really close. In this whole business, this market is under heavy distribution. This high is lower than this old high. But look at this. This is the NASDAQ futures. Okay, so the relative highs for the S&P is this in the NASDAQ futures. And look what's going on. We're making a higher high here right away, there. Dow, we're not. So just like the S&P, we're making lower high, NASDAQ, higher high. This high is comparable to this one. This high is comparable to this one. This high is comparable to this and this as well. But the overall context of what we're looking at is during the time it returns back to that volume imbalance on the daily chart, and then in time it spends in that volume imbalance, look at the heavy distribution that's coming in. Smart money is selling S&P. They're selling Dow. They may have bought NASDAQ here, but right here it starts to do what? Peter out. Why? Because it can't lead the market forever, especially when there's a narrative that the algorithms are going to follow. The S&P went up into that daily volume imbalance like we talked about before it happened. And then once it got there, I said, I'll have to see what it does to indicate whether or not it wants to go higher or lower there. What I just showed you here is heavy distribution between the NASDAQ. So right away we have an SMT divergence between the S&P. I have to take this magnet off here. So we have distribution heavy in S&P. So while it's hanging around in here, and other people would look at this as a consolidation and next leg up, we can see the heavy distribution for all of the indices with this analysis here. Lower highs, higher high. So now we have an index divergence. Okay, so this is indicating that the underlying pinnings of the market is suggesting that we're going to go lower. And then when you have that, that's your narrative. You wait for what? Everything else I've given you here in this lesson where we look for the break in market structure. After that happens, we always anticipate a retracement. Retraces back into what? Bearish order block. Why is this order block? Because it has the imbalance coupled with it. Rebalances, and then we wait for this trigger here. Now there's several things you can do. You can also be a short seller on a stop below this low, but that means you're going to have to take a whole lot more risk. But if you're a position trader or a swing trader and you don't have to be in there all day long, and you're okay with taking small positions with larger runs in price, then that stop above here, this short-term high, wouldn't make a bit of a difference. It's still relative in terms of risk. But I'm just not like that. I have to be down in the lower time frames. And we can reduce this down to the lower time frame and make it even smaller in this. But the whole narrative is that the low here breaks, market structure is broken. This rally is suspect. This rally just raids the relative equal highs. Then it runs quickly. Why is this big sudden run? Because it cleared up another level of buy-side liquidity. They tapped it, flooded the market with buy orders, so they can couple it with what? Selling short. And then, boom. All the things I've covered in here in this video are exceptional signatures. And they repeat, not just in the indices, but they repeat across all other asset markets. Now, the factors of bringing in the NASDAQ and the Dow with the S&P, that's basically for index futures. But what do you do with Forex? You would use the dollar index and the euro dollar. If this was, say, the British pound, then you would have euro and dollar. And does the divergence occur with the regular SMT study, the triad? It's the same thing, folks, but you just have to look at things with the balance of what's the tool I'm using right now. Is it a timing tool? Is it a confirmation tool? Or is it a selection tool? And SMT is a confirmation of something. You're already anticipating anyway. So when we look for the divergence in the indices, we don't just go in there looking for a divergence, because the divergence alone doesn't mean anything unless the underlying narrative suggests what was the basis, that volume imbalance on the daily chart. When it goes up to it, okay, it's going to create what? A rebalance. And once it rebalances, then it's either going to go higher or it's going to go lower. What are you waiting for? Does it create a break below this low? It does here. That's a market structure break. That means now if it goes below this low, it's dead on going lower. Then you have to know where your levels are, as I just gave these. And there's a lot more of them on that chart I could have given you, but I've left some room for you guys to study as well. But a beautiful delivery of the weekly range, Thursday low of the week, and then consolidating off into Friday's close. So hope you enjoyed this lesson, and I'll talk to you this weekend. Till then, wish good luck and good trading.